Hello and welcome. You're watching AYC here on ET Now. I'm Harsh Saita. Today we're going to be talking about Sanghvi Movers and why this company, first off, is to first try and understand what it does. It does crane rental leasing, and currently what we are seeing in terms of a trend within the CV space is very, very strong traction, right? And I'll quote M&M Financial here, just the disbursement growth was extremely strong sequentially. So is there an uptick with regard to the kind of traction they are seeing on their business? Is demand significantly higher? How is all of that playing out? And whether this could potentially be an opportunity. Let's first talk about utilizations. Utilizations are set to improve. They're sub 75% in H1, FY26. Despite that, growth was strong. And they're set to improve. The aspiration is to get it to 75 to 80%. In years in which they've done more than 80%, you've seen very good margins, you've seen very good profitability. But we'll have to try and understand better where directionally is that utilization number going. Second piece, they're getting into Saudi Arabia as a market. Currently, they are 100% domestic focused, but the aspiration is to become the top 3 player in Saudi Arabia. How quickly do they get there? How large is the demand there? And what will the revenue mix be? India, crane rental versus Saudi Arabia, crane rental. That will give us a sense on what contribution will come from India and Saudi Arabia. The growth guidance, viewers, is just 10 to 15% on the crane rental piece. On overall revenue, it's around 25%. Is there a surprise on the upside for FY26? That's the third piece I'd want to know, because growth has been extremely strong in H1. What is in store in terms of H2? And how do margins therefore shape up is the other piece I'd want to know. EPC, that's the other business that they forayed into. Why EPC? Because they're doing a good job at crane rentals. They are one of the top players globally as well as in India. Why allocate capital to EPC, where the margins are significantly lower, versus the crane rental business? I'd want to understand that. Likely the answer is growth, because they want to push growth out to 25%. The crane rental business does only 10 to 15%. But what we will do is we'll ask management for the rationale behind that. And therefore, what happens to margins? Because EPC margins are nowhere close to crane rental margins. In fact, the company does 35% plus margins, and the EPC margin number is maybe 11% or just about inching towards double digits. And therefore, you will see a large margin dilution if EPC continues to execute in a larger fashion on the top line versus crane rentals. So we'll try and get a sense on how they are planning to strike that balance. Last piece is with regard to capital allocation and capex for FY27 and beyond, because that will give us a hint on how strong the traction is that they are seeing. And if they are upping their capital allocation guidance, then that means that they are truly bullish with regard to how the business is playing out on the crane rental side. So we'll try and get a sense of that. Now let's talk and get you a sense of what the company does. It's Asia's largest and India's and globally the 5th largest crane rental company. In terms of the core, it's crane rental and wind energy EPC is what it does. India operations is largely what it caters to. They've just about started the Saudi Arabia operations, and we'll get a sense of where it's placed and what the aspiration is that they want to be the top 3 player there. In terms of the business model itself, they have 400 cranes on their balance sheet, entirely purchased by them. They buy cranes and lease it out. The lease or the rental yield is approximately 2%. Of course, utilizations mean that around 70 to 75% only of the cranes are actually getting leased out. But the aspiration is to get towards 80%. The rental yield is around 2%, and the utilization target is 75 to 80%, which I just spoke about. Let's talk about the key products. One is your crane rental, second is your wind EPC, third is your project EPC. All of these are largely self-explanatory. Wind EPC is nothing but wind farms which are actually built by Sanghvi Movers or enabled by Sanghvi Movers. It's a forward integration strategy where they own the cranes, and therefore a large part of the cost in any case can be picked up because they have idle cranes available, and they can use that towards construction of wind EPC projects. So that is probably one of the logics or the rationale behind getting into this. All sales currently are from India, but they're aiming to diversify into Saudi Arabia. That's the goal, that's the target. And in terms of the geography, Other than the fact that they want to diversify to Saudi Arabia, the India presence has 15 depots across 12 states where they have or they house their cranes, and they have offices in 4 states and 1 foreign office which they've opened in Riyadh, of course, with the intent to go into Saudi Arabia in a larger fashion. Wind EPC, it's largely turnkey projects, which is civil erection and commissioning, which is what they do. Revenue is based on percentage completion method. The revenue split is not given. We'll try and ask management whether they are willing to give that to us. And they use their own cranes, which is what I spoke about. And therefore, you've got that forward integration play, which is beneficial for them. Now, let me talk about the metrics, the financial parameters. You look at the way in which revenue has moved up. It's a very, very solid 42% CAGR over the last 3 years. So they've seen a very good cycle play out. In terms of EBITDA as well, you've seen very similar kind of growth, but a 38% CAGR on the EBITDA front. And the profit after tax has grown at 81% off a very, very low base. So the tailwind across the board is strong. No concerns here. It's all a thumbs up. With regard to H1 FY26 as well, the numbers look fairly strong. And in terms of their margins, it's not a company with very low margins. They've got very, very strong margins. The margins largely fluctuate between 40% and 39%, which is in Q2 of FY26. In fact, it was 37% in Q1 of FY26. So we've seen a bit of a dip with regard to margins, and that's likely because they're doing more or they're seeing more traction with regard to the EPC business where they are executing stronger. That's likely the reason. Let's talk about the balance sheet now. And in terms of the balance sheet as well, around 1,200 crore in terms of book value. And you've got a 3,000 crore in terms of a market cap. And therefore, the price to book is not particularly expensive in comparison to some of the other companies that we do analyze. It's around 2.5 times. But in this business, it's largely steady. You look at the borrowing number, it's at nearly 500 crore. Now, the interesting piece here is that a couple of my team members pointed out that the borrowing is actually being done at roughly 8.5 to 9%, largely likely to be secured borrowing. So while there is a large amount of borrowing on the balance sheet, and that's something you should be conscious about, but it's not at a very high rate, which means that there is lower risk. At least that's what the lenders seem to be suggesting to Sanghvi Movers. And that also means that it's secured by assets. And therefore, the weight of borrowing or interest cost on the P&L may not be as large. And of course, a couple of my team members pulled that metric out. Let's talk about the ROCE ratios now in terms of how it's moved from FY22 to, apologies, we'll look at the cash flow first before the ROCE ratios. In terms of cash flow, you look at the cash flow from operations, it's on an upward trend. FY25 was a tough year in terms of realizations, and therefore that needs to play through. So we've given this a neutral largely because you've not seen a complete flow through of cash flow to EBITDA, at least in FY25. You'll likely see that play through in FY26. Let's talk also about return ratios, and they've not been particularly impressive. You've clocked a return ratio of 1%, and then it's been between 10 and 15% largely in terms of the return ratio. So it's not been particularly impressive. Again, we're cautious with regard to that. Capital allocation going forward, and they're planning to allocate huge capex, and therefore you want to keep an eye out on that number. Let's talk about the shareholding. 47% promoter owned, and when you look at the last 3 to 4 years, it's been very steady at 47%. So I have to give promoters credit for that. Very close to 50, plus the steadiness of the promoter holding gives us the comfort to give this a thumbs up, despite it being below 50%. And therefore, we've done exactly that. Let's talk about management commentary. They've guided for 25 to 30% growth going forward. Crane business to grow at 10 to 15% odd. The capex is going to be around 629 crore, and they aim to be the top 3 player in Saudi Arabia beyond FY26. That's the aspiration and the guidance. Now, in terms of the valuations itself, I haven't stacked it up, but that's a stack of all the metrics that we have tracked. But the valuations, it trades at around 17 times earnings. If I extrapolate the 25 to 30% growth, it trades at around 14 to 15 times earnings on a conservative basis, given margin dilution. So I've factored in margins of only 33% in my math, and if that were to play out, around 14 to 15 times earnings is what this trades at. And in fact, 2 years forward, it trades at 11 times at a 31% margin. So that's broadly the way in which one looks at this. And of course, we've stacked up all of the ratings for you. Now, let's go across. We have Rishi Sanghvi, who's the managing director at Sanghvi Movers, who's joining us live at this point. Firstly, Rishi, great having you. Let me first start off by understanding what the strategy in Saudi Arabia is and how that's playing out. Give us a sense on how the business ramp up is playing out and how much will it contribute to your top line, maybe a couple of years from now when it's fully charged.
Hi, good afternoon, and thanks for having me on your show, Harsh. So Saudi Arabia is a very interesting market for us. As you rightly mentioned, it is our goal to become a top 3 crane rental player in Saudi Arabia. We got our company registration in June 2025, started commercial operations in November, and by the end of this financial year, we will have approximately 50 to 55 cranes on the ground in Saudi Arabia. Now, mind you, all these cranes are moving directly from port to site. So as of today, we have 100% capacity utilization in Saudi Arabia. We see an inquiry pipeline of about $45 to $50 million. And this pipeline has given us a visibility for the next 24 months. Now, the country itself, in terms of infrastructure, construction, oil and gas, is booming. Saudi Arabia has made global commitments in terms of the FIFA World Cup, the Asian Games, the World Expo, as well as all the giga projects that the PIF is executing on behalf of the government. So we are very bullish. We see almost $1 trillion worth of construction and oil and gas projects in the next 5 years. And we are extremely bullish on Saudi Arabia.
So how much of your top line, sorry Rishi for interjecting, how much of your top line therefore will come from Saudi Arabia? Talk to us about FY27 as early as that, because you're clearly seeing very strong traction.
Yes, so I will not give you a percentage contribution from Saudi Arabia, but what I will say is that we will break even in the first half of next year in Saudi Arabia. And we will have a positive, not only top line, but also bottom line contribution coming from Saudi Arabia in the next financial year. If you ask us our long-term plans, we expect 50% of our crane rental business to come from Saudi Arabia within the next 5 to 8 years.
Perfect. You spoke about 50 to 55 cranes, which are being currently transported to Saudi Arabia. Are those currently already owned by you, or are those fresh purchases you've made?
They're entirely fresh capex. This is brand new cranes that we are importing into the country of Saudi Arabia for that market.
Got it. And your H1 FY26 numbers already look quite strong. Now you're saying that at least on the top line, Saudi Arabia will contribute significantly. May not be on the margin count, may not be on profitability in FY27. That may only happen in FY28. And I'll come to the margins and profitability. But top line, you've guided for just 10 to 15% growth on the top line front in the medium term. Why is that? If Saudi Arabia is such a large opportunity and going to comprise nearly 50% of your top line, why is it that, of the crane business, why is it that you're just guiding for 10 to 15% growth?
So, two things. One is that we will be profitable in the next financial year, which is FY26-27 in Saudi. So it's not 28, but 26-27. Our initial guidance of 10 to 15% was made on a capex of approximately 230 to 250 crores. In the last board meeting, the board of directors has approved a capex of 630 crores. So our capex has gone up 3 times, and this incremental capex will add to higher revenue growth on the top line. So this year we are confident that our overall revenue for the group, which is the crane rental business, the EPC business and Saudi Arabia, will definitely cross 1,000 crores. We're sitting on an inquiry, on confirmed order book of 1,250 crores, which is executable in this financial year. And we're sitting on an inquiry pipeline in excess of 2,500 crores.
No, 1,000 crores, Rishi, is a given because you've done 960 crores last year and you're guiding for 25% growth on your top line. So this doesn't give me the information I want. So are you guiding conservatively for the crane rental business, given that you're venturing into Saudi Arabia? So Is this 10 to 15% growth on the crane rental business that you've guided for a far, far conservative number? Because otherwise, it's not adding up.
I wouldn't say it's conservative. I'm just saying that we are prudently cautious. As a principle, I always like to deliver and then comment. Let Saudi Arabia fire on all cylinders. We are very bullish on it, but it will definitely add to significant revenue contribution. Also, bear in mind that our commercial operation started in November, and most of the cranes will be coming in the months of February and March. So the revenue contribution will not come in this year. We will see the revenue contribution coming in next year.
Absolutely. Okay, so point taken. Now, what does this do to margins, Rishi? Give us a pulse. Firstly, you've entered EPC, and I'll come to EPC in just a bit. But what does the pure crane presence in Saudi Arabia do to your margin number in terms of your current margin of around 37, 38%? Does it shrink it? Does it, and by how much in FY27? I know that you're going to be EBITDA positive in FY27. You clarified that. But I'm just trying to get as to how much of a positive is that?
Yes. So in our crane rental business, again, 37, 38% is our blended EBITDA across all businesses. In our crane rental business, we have a EBITDA of about 52 to 55%. Now, Saudi Arabia is EBITDA, although yields are higher, so there is better pricing in Saudi Arabia. And yields are higher in Saudi Arabia as compared to India. Our cost of operation is also significantly higher in Saudi Arabia, and therefore we see EBITDA margins. We are confident of generating EBITDA margins between 40 to 45% in Saudi Arabia. Given time and scaling up the business in Saudi Arabia, we believe that we can push those EBITDA margins because we have 3.5 decades of experience. We are the 5th largest crane rental company in the world, largest in Asia and India. We believe that our legacy will and our history and all our intellectual property will allow us to push that EBITDA margin from 45% closer to 48 to 50%. So overall, in the long run, I would say both the India business and Saudi business would be on par with a blended EBITDA of between 50 to 53, 52.5% on the crane rental business. And Saudi will start adding significant contribution to the EBITDA at a group level in the second half of the next financial year.
Perfect. So very clear guidance, Rishi. Thank you for that. Let me talk a little bit about utilizations here in India. In Saudi Arabia, no concerns with regard to utilization. India utilizations, have you seen them go up materially? Because the anticipation was H2 will be stronger. But and I'm just alluding to the CV volume growth that we've seen in the industry. I'm alluding to to some of the CV lenders who have declared very strong numbers. Are utilizations materially higher? I just want to get a sense.
Yes, so definitely the second half of this financial year has been better than the first half. The first half, I would say, we were still in a sluggish period due to the preceding years having extended monsoon, general elections, and an overall slowdown in government spending. But I would say significantly the second half and third quarter appears to be better than the first half of this financial year, and we see significant traction in terms of utilization. We're seeing strong demand from cranes across all core and infrastructure sectors, be it oil and gas, steel, cement, nuclear, thermal, wind energy, metros, railways, bridges, ports. So all sectors of the economy, there is a thrust for and a huge demand for cranes. The entire 630 crores, of which approximately 400 crores is being spent in India. All of that is also going from port to site. So there is nothing that is coming which is being idle in terms of new capacity addition. It's again 100% utilization on new capex.
100% utilization on new capex. On the existing 400 cranes you have, you seem to be again guiding for very, very strong utilization. Will it be between 75 to 80 full year? Is that where you expect to close? And will it be on more closer to 80 than 75?
Yes, I think I'd be comfortable, Harsh, giving you the range between 75 to 80%. Definitely above 75%. As a management, we hope we'll close towards 80.
Close towards 80. Okay, so that's super strong. Okay. And with regard to sustenance of this, you expect it to sustain into FY27 as well, the India demand?
I'm a firm believer in the India growth story, especially due to all the actions being taken by the Honorable Prime Minister and the BJP government. I do believe that there is strong infrastructure demand. The demand for energy, for core services such as energy, cement, steel, is quite strong. All private and public sector undertakings have announced significant capacity addition, and this gives us strong visibility going into the next couple of years. So I do believe that the demand for cranes will sustain in the coming quarters.
Okay. And Rishi, with regard to EPC, why get into that business? You're doing ever so well in cranes. You're the number one player in Asia. Uh, you're within the top 5 globally. Why get into EPC?
So for us, it's an international expansion on our core business and hence Saudi, and a lateral diversification into EPC. We are being very cautious in, EPC has a stigma, but we are being extremely cautious in what type of work we're doing. So we offer uh, conceptualization to commissioning services for the renewable wind energy sector. Now, the wind energy sector in India is on fire. This year, the country is going to add 6 gigawatts. And it is the nature in the industry where our customers are coming to us and pulling us, saying, "You are the experts in the cranes. Can you help us deliver services across the entire wind sector, across the entire value chain of the wind sector?" If you look at all the IPPs, be it the Suzlon or the Inoxes, they too have come back to their EPC grassroots, where Suzlon itself is being given guidance that they will be more than 70% of the revenue they want from both product and EPC supply. So this is on the money. We started Sangreen Future Renewables Private Limited. We started that, we carved it out as a business in October 2025. Now that adds to 30% of our bottom line today. We have a 2 gigawatt order backlog. We are emerging as a premium player in this space. Our customers have a lot of confidence on us. And because of this, we are able to charge a premium. So we believe that our EBITDA margins on this EPC side, at least for the renewable sector, will land around 15%. And for us, we are very comfortable because the entire project receives financial closure before any independent power producer executes a wind farm. So for us, payments have never been a challenge. In fact, our receivables are below 45 days in this sector. And we are very comfortable and confident in the services that we are offering.
But perfect. So Rishi, that's a good sense we get. But your receivables otherwise, in terms of the number of debtor days, it's gone up materially. You expect that to fall, and your cash flow from operations therefore haven't converted. Or rather, your EBITDA hasn't converted to cash flow from operations. Is that at all a concern for you?
That's a good observation. I would say this is something more internally. We have the management is now focused on this. The board has also guided the management regarding receivables. And we do believe that in the following 2 quarters, this number will significantly go down into double digits. I think we are around 120 odd days right now, but we will be below 100 in the coming 2 quarters.
Okay, below 100. So cash conversion will pick up
Will
materially
improve.
is what I'm trying to understand. Okay, but why has this happened?
It's more of an internal challenge rather than something external. So, as a management, we are focused on improving this.
Okay, yeah, point taken. All right. The fresh capex you've done, 630 crore. A large part of that is domestic, around 400 crore from what I understood from you. Around 250 crore is international. Are you
Yes.
done with the capex cycle, or would you have more capex coming through in FY27?
No, we will definitely be spending more money in FY27. The management will put up its proposal to the board in February of 2000 in next month. And at that time, once the board approves it, we will be able to announce a capex plan. It wouldn't be on the similar lines of 600 crores, definitely below that number. But we can assume that between this year and next year, the company would do 1,000 crores of capex.
Okay, 20 seconds, Rishi. Would you do that capex through internal accruals now?
We are funding it partly through internal accruals and partly through long-term debt financing.
What would the split be?
It's generally 30-70. 30% of
Perfect.
us internal accrual.
Perfect, perfect. Thank you so much. Thanks, Rishi, for coming
Thank
in and
you.
speaking with us. You've been super candid. And that, viewers, is all that we have on this edition of AAYC. I hope this gives you a detailed understanding of the company. Thanks for staying with us.